LBR LBO Debrief.
Next session is going to be light entertainment because it's about budget. Okay. So generally in other countries, I believe the practice is that you have consultation before the budget. But in Sri Lanka, we have established a very interesting tradition because we have consultation after the budget. And we have some of the consultation taking place in streets. So I think we are pioneers in economic reforms in Asia, and we are also pioneers in setting new budget in new trend in budget formulation in this country. I would like to the afternoon first session is going to be first. Deshal is going to talk about budget 2017. I don't know to preempt, but I simply can't resist his title. His title, the good, the bad, and the ugly. It's like a Western movie. So I'm sorry, I preempted you, So Deshal will take us through next half an hour, his take on the budget, and then we have a panel discussion with some great speakers, people who have great insight to the economy and the industry. Over to you, Deshal. Ladies and gentlemen, please welcome Deshal de Mel. And I'll show you plus 5 minutes. Okay.
No problems. Good afternoon, everybody, and thank you very much to LBO LBR for the opportunity once again to have a chat about some of the recent policy developments and the implications of that on outlook for the next year and outlooks on overall economic policy and the way forward for the directions of the Sri Lankan economy. So yeah, I'm going to speak about primarily about the budget 2017 and the implications thereof, the good, the bad, and the ugly, as was preempted. And I think it's important to always have a bit of a historical context as well. For me, I think when we stood here this time last year, it was a fairly different situation. We had already had a budget in the early part of 2015. We had the short-term budget that came in February, and that had a lot of I would say sweeteners with some big increases in public sector wages, a number of price reductions on essential items, and basically it was a very populist budget that came in February 2015. Subsequent to that, in November 2015 for the more regular budget, there again we had a number of and further increases on the fiscal expansion side and rather unrealistic revenue targets that we discussed on this stage during that time. And at that time, the markets also reacted quite badly to that kind of expansionary fiscal situation that we saw in the previous budget. And that situation was really accentuated by the fact that global markets were also in a fairly volatile and uncertain period. In December last year, we had the rate hike by the U.S. Federal Reserve. So anyway, global markets were quite jittery, and we saw movements of capital out of emerging and frontier markets. And in that context, with Sri Lanka's perceived weakening on the fiscal side, things became fairly negative in terms of confidence. We saw global markets basically losing confidence in Sri Lanka's fiscal consolidation path around this time last year into early 2016. Things kind of came to a head in around March 2016. We saw the secondary market yields on Sri Lankan US dollar denominated bonds going up above 8% in the 5 years and beyond tenors, and that was a really unsustainable level. It was a level at which we probably couldn't have been able to refinance and roll over our debt at any kind of affordable level. So it was in that context that that we've had to go to the IMF. The agreement came through in June 2016, and that was really seen as an anchor that brought in returning some degree of confidence to Sri Lanka's fiscal situation. And that momentum has carried on in the last few 4-5 months as well. We've seen an improvement in government revenue collection also in the first 9 months of 2016. That done along with the fact that there was a change in leadership in the central bank. The government was able to tap into global markets in late July 2016. So all of those general positive movements were really manifestations of improved confidence in the Sri Lankan economy, in Sri Lanka's macro fundamentals, particularly by the global market. And it is in that context that we arrived at the budget for the 2017 budget that was going to be presented in November. And there was a lot of concern, a lot of expectation in the market as to how this budget would stand compared to last year. Would it again step into that fiscal expansionary path, or would we see a more consolidation approach, a more conservative approach? And really, what was the order of the day was really a sort of austerity budget. And it is actually that the outcome actually has been relatively positive in that context. The budget that was presented has not been one that has looked at being too expansionary. It is initially a lot more realistic, and that is the kind of context that I want to really present this afternoon. So, as I was saying, the most urgent priority for the budget 2017 was to really reinforce this macroeconomic, the fiscal consolidation path. I think that was the absolute priority from a global market perspective, and basically the requirement for Sri Lanka to be able to service its debt and to be able to balance its macroeconomic path. And as I said, the 2017 budget has actually been a lot more realistic in terms of its revenue targets and its expenditure expectations. If you look again at last year, the revenue growth expectation for 2016 was about something like 38% growth. And that didn't really have the teeth, didn't really have the kind of revenue measures to justify that kind of huge increase in growth. We have seen fairly positive growth, around 20% in the first 9 months, though the budgeted, the projections that have been given in the budget for the full year are a little bit less than that. Nonetheless, there has been some improvement in 2016, and that appears to be largely driven by some degree of administrative improvement as well. But what is heartening is that there has been a broader improvement on the fiscal side in the first part of this year also. Even on the expenditure front, it's a relatively conservative budget for 2017 also, and both of these measures are actually quite good. So what we are seeing is a general improvement in direction. So in 2015, we had the budget deficit really ballooning out of control to 7.4% of GDP. The projected deficit for this year, for 2016, is 5.4%. It might end up being slightly higher than that, but still relative in a fairly comfortable position and a lot better than it was in 2015. And the estimate for 2017 is 4.6% of GDP. And that would be an excellent number if we are able to meet that target. And I don't think we'd actually be too far off, just judging by the numbers that we have and the kind of assumptions that the government has been working with. So, touching initially on revenue trends. So, what I want to do is just to look at some of the headline areas and compare it with what I would think are the policy priorities for Sri Lanka's economy and the other stated longer-term economic objectives. Now, one positive change is that there is a lot more focus on trying to enhance income taxes. And that is really what I would see that as a desirable shift towards a greater balance between direct taxes and indirect taxes. Direct taxes obviously are a lot more equitable in terms of its impact on social justice as well. And at present, we have about a 20% collection from direct taxes and 80% from indirect taxes. And that is, of course, I would say that is an imbalance that is not an equitable situation from a national interest perspective. So the government's stated objective is to move towards a 40-60, with 40% collection from direct taxes and 60% from indirect taxes. And I think that is it's a good direction to work towards. And this budget, we have seen certain steps taking us in that path. Still, you're going to see a big contribution coming from indirect taxes compared to direct. It will be about 25-75 if the numbers work out the way that is being expected. But still, the direction of change, as I said, is quite good. You're seeing a lot more emphasis on. We've seen an increase in the rates of personal and some corporate income taxes as well in some cases. And also, I think importantly, there's been a number of tax incentives that have been rationalized. Now, this could have some detrimental impacts in the short term for certain sectors. So, for instance, in some of the financial instruments, there has been a removal of some of the tax incentives that have been given. It was these tax incentives that drove the growth in these instruments. So, for example, things like corporate debentures in the secondary market and so on. Some of these incentives have now been removed. Also, if you look at some of the areas where corporate income tax has gone up from the concessionary rate of 10 or 12% up to 28%, sectors such as tourism are going to be affected by that. So these may have some kind of detrimental impacts in the short term on some of these sectors and some of these areas. But the way that I would look at it is that taxes really shouldn't be seen as primarily be seen as a tool of kind of trying to create incentives for growth of sectors and so on. Taxes should primarily be seen as a revenue instrument. That is their primary objective. There should be other measures of ways of trying to encourage certain sectors or to stimulate the development of certain business areas or certain areas of national interest. Taxes should really be seen as a revenue generation tool and really nothing else. I think one of the problems, one of the reasons that we have seen such an erosion of Sri Lanka's tax buoyancy, the fact that our tax to GDP ratio has come down so rapidly in the last decade or so, is the result of the proliferation of all these tax incentives and tax exemptions. So, as a broad policy, the thrust towards rationalization of tax incentives, I think, is good. Of course, you're going to have short-term implications on some of these sectors, but I think we should focus more on trying to encourage these sectors through alternative measures instead. So, looking at the realism of some of the revenue targets that we are seeing, if you look at, for instance, corporate income tax, personal income tax, there are significant expectations of growth, around 40% in some cases. Now, here, for instance, there is a lot of the onus on the growth on tax revenue is coming from improvements on the administrative side, and that is something that it leaves a little bit of room for uncertainty, the extent to which that could actually materialize. There is reason to believe that it is possible, given the implementation of measures such as the RAMIS system, which is expected to improve the information systems available to the tax department and thereby better enable collection of revenue than what we have been seeing in the recent past. So, along with the administrative improvements, of course, we have seen significant rate increases on the income tax side. So that should also provide some kind of support to this. The government's primary the assumption in its revenue calculations is also a base increase supported by real GDP growth of 6.3% and inflation of 4%. Now, I think this is there's a slight overestimation on the real GDP growth. I think 6.3% would be fantastic, but I don't know if that is something that we could actually achieve. And I also think the inflation figure is probably understated. So, what is relevant in terms of the implications for tax collection and revenue is nominal GDP. So, even if you have, say, real GDP growth of 5% and inflation of 5 or 6%, then you're coming to a fairly similar level to what the government is estimating at 6.3 and 4. So, I don't think that is too much of a problem. Your revenue base should be still growing at the level that the government has in its assumptions as well. So, by and large, I think the corporate and the personal income taxes, the government should be able to come towards its target as long as it's able to achieve the the administrative improvements that have been envisaged. So that will be the key. It's also heartening to note that in the budget speech itself, there's a lot of emphasis on some of these administrative improvements. So clearly there has been some kind of focus and understanding of the importance of this to achieve the targets that have been determined. Where I feel that there could be some overestimates is really on the import taxes side. The government is again assuming about a 7% growth of imports into 2017, and I think this again might not materialize. Largely because I'm expecting next year demand to be quite subdued on aggregate level. So when aggregate demand is quite low, you're generally going to see less demand for imports as well. Also, the global economic situation is such that I don't think you're going to see significant rises in commodity prices as well. So by and large, the scope for import expenditure to increase by 7% or above, I would say, is quite limited. At the same time, as always, a significant proportion of the imported revenue expectations is coming from excise duties, and excise duties on motor vehicles in particular. Here again, it's I don't see the demand for motor vehicle imports is likely to be subdued, because interest rates are going to probably remain quite high into 2017 as well, and also with the changes in the loan-to-value ratios for motor vehicles, the demand side on that side is probably going to be quite muted. So I don't see a lot of realism in the import tax generation side. Also, for instance, there's again an expectation of import of earnings from cess to be increasing, but at the same time, the speech mentions a reduction of cess on about 100 items. So some of those things don't exactly tally up. But I don't think overall, even with the potential overestimation on import-based tax collection, I don't think you're going to be too far off, because particularly with the increase in VAT from 11% to 15% and some of the other changes on VAT and NBT, I'd expect there to be a significant collection on the indirect taxes on the domestic front as well. So on an aggregate, you're looking at revenue targets being not too far off what has been estimated by the government in their projections for 2017. There might be a slight discrepancy, but I would expect them to be reasonably within line of sight. Moving on to the expenditure side. So here again, you're seeing recurrent expenditure has been projected to grow at around 10%, and that's a fairly reasonable level considering general increases in nominal GDP during the time frame. With regard to salaries and wages, it's a fairly nominal growth that is being projected. Some growth in terms of some of the transfers and subsidies, but there could also be expected to be some kind of savings in terms of better administrative measures in terms of procurement and so on as well. So whilst recurrent expenditure is projected to grow at 10%, overall expenditure is projected to grow at 17%. And the big increase is, as usual, coming from the projected growth in capital expenditure. Now, there's a 42% capex growth that is being budgeted, but this again, I think, is unlikely to materialize. If you look back at Sri Lanka's history, what has consistently happened is that we would tend to overestimate on the revenue side, and then try to catch up in terms of to meet the budget deficit target by cutting back on our capex. So here again, I think that is likely to be what would happen. Even though we may not miss too big on the revenue side, we're likely to not see this 42% materialization in capex growth in 2017. And that again, I think is not an ideal way to go about budgeting. I think it makes much more sense to have a more pragmatic target on capex and focus it on the areas that really would matter. So areas like education, transportation infrastructure, connectivity infrastructure, health, and other key social infrastructure services. Have a focused capex plan for those, but without having this kind of large estimate and then being forced to cut back without being able to plan that in a proper way. So this has really been the practice historically as well, and I'd expect probably a similar movement in 2017 also. So looking a little quickly at the borrowing strategy that the government is projecting for 2017, there's a projection of shifting a little bit out from foreign commercial borrowing sources. So probably maybe less emphasis on SLDBs and sovereign bonds. And 2017 is likely to be again a fairly volatile year in terms of global capital markets, particularly for emerging and frontier economies. So countries like Sri Lanka that are looking to tap global markets to roll over debt or to finance their expenditure are likely to find it quite tricky because of the significant political developments and the political movements that we've seen in the global environment and the implications of that on capital markets. So we've already seen in the post-Trump and before that post-Brexit situation, there was capital that was going back and forth out of frontier and emerging economies. And I think 2017, we're likely to see similar movements as well. Also with the Federal Reserve decision that is coming up in the later on this month. And again, the projections for how rates are going to increase in the US going forward into 2017, that again will have important implications for the movement of capital markets next year. And that will have very important ramifications for the way in which a country like Sri Lanka can borrow and tap into global sources. So the government is looking at probably less reliance on global capital markets. But even on the domestic on the non-bank borrowings is less than what has been projected last year, but still quite significantly higher than what has been in the previous years, 2014, 2013, and so on. The one area where I think there might be some kind of misalignment or overestimation is that they are expecting a positive inflow into the foreign investments in rupee-denominated government securities. This might be a little bit tricky to in terms of realization. Because again, as I was saying, in terms of the current global environment is not in a particularly conducive situation to expect significant inflows into rupee. Foreign investments into local government bonds and government bills, and also some of the tax changes that we have seen in some of these instruments may also make the secondary market in some of these instruments less liquid, and that could also be a discouraging factor. So I would keep an eye out on that. And if we don't see significant foreign inflows into the rupee security market, we might have to see more government borrowing either on the domestic capital in the domestic capital market or from foreign sources as well. So I think that is something to keep a lookout for. The way that I would see 2017 and the early part of 2018 is a really good chance to consolidate our fiscal position further, because if you look at the 2017 and early 2018, there aren't a lot of significant external repayments that are coming up in those 2 years. The big payments start building up from 2019, 2020 onwards. So we need to use these 2 years to really consolidate our position on the fiscal side, and so to make sure that we are on a good wicket when it comes to when the big payments come up, and the markets will then have confidence in our fiscal position, and we'll be able to refinance at a reasonably affordable rate. So that should really be the priority for 2017 in terms of its borrowing strategy as well. So looking at the likely macroeconomic implications, as I was saying, the more pragmatic deficit target that we are seeing for 2017 is really likely to ease the government's borrowing requirements. If you look back at 2015, with the deficit going up to 7.4%, there was a big requirement for increases in government borrowings. That, of course, draws out capital from the market that is available for the private sector as well, drains liquidity, pushes up interest rates, and makes things quite tricky. With the deficit being expected to be reduced, we could anticipate that the government's borrowing requirement is likely to be somewhat less, and therefore the drains on liquidity are likely to be less as well. So this should enable interest rates to remain around present levels up to into the first half of 2017, and if all goes well, to enable rates to start easing off in the second part of the year. Now, another point to keep in mind is that with some of the tax changes that we've seen on the government security side, there has been an uptick in interest rates as well, which is not predicted by most people. That is moderated to some extent in the immediate post-budget scenario, and there's still a little bit of uncertainty as to the implementation of some of these areas, but that is another point to keep in mind in terms of the movement of interest rates going forward as well. So interest rates, as I said, likely to remain elevated into at least into the first half of 2017, and demand is also likely to be fairly subdued in 2017. Also, particularly with the tax increases that we have seen on the domestic economy, further enhanced by the fact that interest rates will be high as well. So generally demand is likely to be subdued. Economic activity will be quite low, I think, in 2017. It will be quite a tough year for business in the domestic front. Imports, as I said, also likely to be remain quite moderate and modest in 2017. So the current account should be quite stable also, and that would be supportive of Sri Lankan rupee value, at least from domestic forces. External forces are a very different story. There's a lot of volatility that I would expect in 2017, and I think that would be the driver of whatever depreciation we see in the rupee into 2017. With the tax increases, of course, there's also going to be a one-off hike on the inflation side, but that's not really a demand-driven inflation. It's more of an artificial jump in the index. So I don't see too much kind of central bank concern about that from a demand perspective. But still, I'd expect inflation to remain at mid to high single-digit levels, around 6 to 7% into 2017 as well. So then are just a couple of points on the kind of broader policy orientation of the budget. If you look at the strategies of the government, they have been looking at things like of driving export orientation. And there have been some measures in the budget that have been supportive of this. For instance, there's a significant reference to trade facilitation measures that is good in both in terms of imports and in terms of exports. Phasing out of some of these ad hoc taxes such as cess. These are things that have been problematic in terms of trade for a long time, and it will be positive if it can be done. But again, from the revenue perspective, it might not be something that can be done immediately or in the short term. But it's good that this is at least being thought about. Exim Bank, that is something that was not implemented in 2016. Again, it's come up in the budget. References to FTAs with some of the key markets in emerging markets in Asia. I see that as a positive, particularly in terms of positioning Sri Lanka as a kind of trading and logistics hub for the Indian Ocean region. I think that is a useful kind of supportive mechanism. Easing of foreign investment in land. Again, I think that is a positive in terms of supportive of FDI and supportive of a broader outward orientation of the economy. In terms of short-term challenges, the removal of SWAT is, I think, going to be something that will be problematic for some of the exporters, particularly in the context of it being still in the early stages of the implementation of RAMIS. Now, if once RAMIS was fully established and there was a proven system and an effective method of administration, at that point bringing in SWAT, I think probably would have been a more pragmatic approach. But this could cause some kind of cash flow situations for some of the exporters. In terms of education and skills, which I would see as the other kind of major long-term macro priority, the budget speech again refers to investments in curricular development, teacher training, and so on. But there is very few specifics in terms of how this is really going to be taken forward. The focus, though, continues to be on investment in physical infrastructure, more than on reforms of education per se. And I think really we should try to flip that on the head. We should try to focus on enhancing the reform process particularly of curricula, particularly of teacher training and the way that we actually teach. Sri Lanka still has a very exam-centric education system, and we don't really create the kind of skills that are required by the modern economy. We don't generate skills such as creativity, problem solving, analytical skills, being able to think out of the box. Those are not the skills that we are really inculcating, and that is really what we should be doing. So I would have preferred to see the budget focusing more in terms of giving more clarity on direction in terms of how we're going to spend money on these reforms to kind of generate this kind of big changes that we need in education as well. In terms of higher education, there's reference to enabling greater private sector supply of higher education. I think that's a big positive, and I hope that we see implementation of that going forward. In terms of finance, one negative that I want to point out is that there was a lot of reference in the budget, which is the Finance Ministry Treasury policy area. There's a lot of enroachment, I would say, into the central bank's domain. And I think that is a negative because the central bank should be an independent body being able to determine policy on the monetary side without significant influence from the fiscal arm of the government. So the fact that there was a fair amount of enroachment from the finance ministry into the central bank, I think, is not an ideal situation, and I hope that that does not continue going forward. In terms of some of the specifics, the capital requirement increases could help consolidate the banking sector. Timeframes, of course, are going to be important to ensure smooth implementation of this. Directed bank lending, I think, is not so desirable in terms of efficient allocation of resources and smooth functioning of markets. Positives, though, in relation to commitments to listing some of the state-owned enterprises, I think that would be good in terms of development of financial markets as well. I think there's a few more areas on the financial sector that we can discuss more in the panel discussion. In terms of digitalization and ICT, just my penultimate point, again here, important to have this move towards greater digitalization of the economy. This was mentioned in the last budget as well. That continuity is there. For example, things like digital ID can really help in terms of things like targeting of subsidies. Again, important tying in with expenditure rationalization and so on. But of course, it's important to address issues like privacy and so on. National payment platform, again, useful in terms of creating the kind of modern economy where payments are done on a cashless basis, done through mobile phones and through other forms. But again, here it's important to clarify, say, what the role of the central bank is and what the role of ICTA is in this kind of policy as well. So again, good direction, but important to kind of clarify the way that it's going to be regulated and the way it's going to be implemented. Again, one of the negatives was the continued heavy taxation of the telecom services, the increase in taxes on data, for instance, above what you're seeing in some of the other areas. I think is again something that needs to be probably reconsidered. So, as a summary, I would say the budget is largely good and not as ugly as we have seen sometimes in the past. So, commitment to fiscal consolidation is certainly a relief from a macroeconomic stability perspective. If we had another expansionary budget, it really would have been disastrous in terms of attempting to manage our debt situation, external debt in particular. Of course, with the increased taxation, you're going to see a relatively deflated economy in 2017. It's going to be a somewhat tough year for domestic business, I would think. But the way that I would see it is that this is kind of a needed short-term treatment to ensure longer-term stability and longer-term sustainability of the economy as well. So I would think the short-term pain is something that is necessary going forward. I would like to see further streamlining of government recurrent expenditure, driving efficiencies in things like procurement, driving efficiencies in human resources, and so on. There was reference in the budget to things like KPIs in the public service and in the state sector. That is again a good development, and hopefully those things will be implemented in a fairly full and comprehensive manner. I would also like to see I would have liked to see more prioritized spending on the reform of education, enhancing the service on the delivery of public services, and focus on efficient and smart regulation. I'm going to leave you with this slide. Just a very broad thought that we are in a situation where we are transiting from an economy where the state has always played a very large role in the economy. We've always had, until about 2006, very easy access to finance from our development partners. We used to always get money for 30 years, 10-year grace, 0 to 2% interest. Very easy to refinance our loans in that kind of situation. So during that time, we built up a very large state sector. Today, we have 1.3 million in the public service, 240 plus state-owned enterprises. The government dominates some of the key business sectors in the economy and so on. And the state basically uses up a lot of the scarce resources in the economy, which the private sector has to compete with as well. So I feel that the time has really come to shift away from this kind of large, economically significant role of the state to one that is more of an entity that sets the rules of the game, creates the institutions and strong institutions, has smart, unobtrusive regulation to address market failure, and at the same time also very effective intervention to address issues of social justice. As we have seen in this year in other economies in the US, in the UK, the failure to address social justice issues is also a crucial area in terms of the future of a liberal economic regime as well. So I think this reorientation of the state is going to be important, and I think what we're seeing in terms of fiscal consolidation is hopefully one of the first steps towards this end. Okay, let me end there, and thank you very much for your patient hearing, and I look forward to your questions in the panel discussion. Thank you.
LBR LBO Debrief.